Hello, in this presentation we will compare QuickBooks Online versus QuickBooks Desktop. Hello, in this presentation we will enter a reversing entry for accrued interest into QuickBooks Online. We will have a comprehensive QuickBooks Online course soon, if not available yet. We also have a comprehensive Excel course which complements the QuickBooks courses and a QuickBooks Pro desktop version course you can find at the link below. Here we are in the QuickBooks Online dashboard. We will be continuing with the Get Great Guitars problem. We've been taking a look at adjusting entries, those entries needed at the end of the time period in order to make the financial statements more correct on an accrual basis as of the cutoff date, in our case, February 28th, the end of the month that we will be reporting. We're now going to take a look at a reversing entry because there's a bit of tension between basically the adjusting process, which often happens by another department, possibly an outside CPA firm, and the normal cycles that take place, and because the two things have slightly different objectives. So just from a logistical standpoint, we may not do things on a perfect accrual basis, and that's just the way the system's best set up sometimes. And then the adjusting process is going to say, hey, we recognize the fact that the system isn't fully set up on an accrual basis because of logistical reasons, and we're just going to make those adjustments as of the end of the month to make it more on an accrual basis as we report those, because that's the best reporting process. So that being the case, in order to get to sync these two things up, some of the items that we adjust for we'll have to reverse for in order to keep that separation between the normal logistical, just accounting process and that adjusting process to tweak the financial statements to be completely correct as of the end of the time period. So what we're going to do now is a reversing entry, and to see that, we are going to go to the reports on the left side, and I think the best report to look at is the profit and loss. So we'll look at the profit and loss statement and see what we did in terms of the adjusting process, and then why we might need to reverse that. So we're going to put the dates here of 01/01/28 to 02/28 to, whoop, let me do that again. 01/01/21 to 02/28/21. So that's the period we're working in, January 1st, 2021 to February 28th, 2021, and run that report. So here's the report that we are looking at. We're concentrating down here on the interest expense. We had some interest expense that we recorded here, and if we select the interest expense item, we're focusing in on this $25. Now I know that's not a large dollar amount, and this is probably immaterial for most companies and whatnot, but the concept remains the same no matter the dollar amount. And so just imagine obviously that is a material amount, and we want to make these types of adjustments. So what we've done here is the adjusting process, as you recall, we looked at this in a prior presentation, is we said, hey, here's the loan, a $5,000 loan, and we don't pay anything, interest or principal, till the end of $5,125. 1 month has passed, and therefore we recorded the fact that we owe the interest, just like we owe rent. If we had been using the building, we owe rent whether we have paid it or not. We consumed it, we owe it. If we talk about the phone bill, if we used the phone for the month, whether we paid the bill or not, we still incurred it, and we should be recognizing the expense at the point in time it was incurred in accordance to the expense recognition or matching principle. So we went ahead and said, okay, we haven't paid this $25 yet, but it's been incurred, and therefore we recorded it here. So this $25 then, back to the QuickBooks here, this $25 represents money and interest expense that was created by a journal entry, which we didn't actually make. We haven't made a check. If we click on that, then there's no money. The credit's not going to cash, in other words. It's just a payable. So we're just recognizing the fact that we incurred it even though we have not yet paid it. So that's fine right there, but when we get back to the actual payment, I'm going to close this back out and go back to the financials. The payment's going to be made at the end of this time period, 6 months, and they're going to pay this $5,152. What we want is to not have the normal process of the accounting department have to deal with reversing our $25 accrual when they make the payment. We want them to just be able to say, hey, make the payment in accordance with whatever system we've made up, which would be just to pay this out, credit cash, and debit the loan amount $5,000 and the difference going to interest expense, without having to worry about what do you do with our accrual thing. And so that's what we're going to do. We're going to reverse our adjustment so that when it goes back to the normal accounting department process, they don't have to look at that 25 and say, what is this? Where did that come from? I don't recognize this. It's not part of my normal cycle, and we'll reverse that. So that's our goal here. We're going to get rid of this so that it will go back to the normal process as of the first day of the next month. So this happened in February. It's going to be the first day of the next month in March that we're going to reverse this. Now, this is not a perfect system. You should recognize this up front. It works well. Again, like kind of logistically, it works well. But what's going to happen is it's going to end up with having a negative expense as of the first day of the next month until we actually make the payment, and those two things will net out. So we'll talk about more what that looks like once we do the reversing entry, and then say why we would want to do that, and is there a better system? Should we be in a better accrual system, and what the pros and cons are of the systems. So to do this, what we're going to do is reverse this as of the first day of the next month, so that the system they don't have to worry about this $25. And note that the 25 is also, if I go to reports over here on the left side, and we go to the balance sheet, we're on the reports, we're going to go to the balance sheet, and we're going to make the balance sheet as of 01/01/21 to 02/28/21, January 1st, 2021 to February 28th, 2021, and run that report. If we scroll down here, we're going to see a similar transaction, and we see this 25. That 25 will be remaining there even after we close out the month of February. It'll still be there in March. And so we're going to reverse that as well. So again, the accounting department might be going, what is that? I don't even know what that 25, interest expense, why is that there? Because the adjusting department put it there. And in order for them not to have to worry about that when they deal with their loan payments, we're just going to reverse it here and make any adjustments we need to make as of the end of each time period that we report, as of the end or the cutoff date of each month. So let's reverse that, and then we'll talk about that a bit more. To reverse it, if we click on this item and we select this item, all we need to do on a reversing entry is just the opposite of what is here. So this is a debit to the expense, so we'll credit the expense. This is a credit to payable, so we'll debit it. We'll just reverse it. And we'll do it as of the first day after the cutoff. So as of the first day of the next month, as of March 1st. So we're actually going to do this because we didn't do this with a journal entry. We put it into the register. So we'll do it when there's only 2 accounts affected. We'll do it with the register, and then we'll take a look at it, and it'll actually create the journal entry. So we'll do it in those 2 formats. So we'll close this back out. And we're going to go to the registers. So that's going to be over here on the accounting side. We've got the accounts up top. And note there's 2 accounts affected, an expense account and a liability account. The expense accounts will not be here because it's temporary typically. So the liability account's what we got to work with, which will be interest payable. It's in order by a type, so assets and more specifically cash, and then receivable, then other assets, then fixed assets, and then liabilities, including accounts payable, credit card, other current liabilities, and then equity accounts. And that means we passed what we're looking for, which is the interest payable. So that's the interest payable right here. This is what we want. There's the $25. We're going to go to the register. So we'll select the register here. And there's only that one item in it. We're going to add something new, and there's only one thing we can do pretty much, and that's a journal entry or a transfer, but pretty much we're going to do a journal entry. And remember, the date has to be the first day after the cutoff. So here's the cutoff date. It's going to be 03/01/21. And we're just going to do the opposite of what we did here. So it's just going to be here, I'm going to call it reversing entry. And this was an increase down here, so now it's going to be a decrease. The liability is going to go back down because we're going to reverse this. And the other side is going to be interest expense. So I'm going to select this. We could find it there or just type in interest expense. So here we have it. It's an expense item. Now this is going to be really funny because we're going to be recording a negative expense, recording basically a credit to an expense, and that normally almost never happens. It's really kind of unusual situation, but we'll kind of explain why we would want to do this. Okay, so we're going to say save on that, and there we have it. So we have recorded that. If we go back to the reports then, back to the reports, we go to the balance sheet, and we select the balance sheet as of 02, let's say 01 21 to 02 28 21, and we run that report. So that's January 1st 2021 to February 28th 2021. We're still going to see that down here. We'll see that 25 right there. But then of course if we scroll back up and we add the date, I'm just going to highlight this and plus the +1 to go to 3/1, so the first day of the next month, and run that report. And if we scroll back down, we should no longer see that 25. It's now been eliminated. So the interest payable, if we select the detail then, we scroll down, it was there right before the month ended, and then it went away. So we put it there because we needed to make the financial statements right, and then we reversed it the day after the financial statements were generated and created. We'll see the same thing on the reports here to the profit and loss. So we'll go to the profit and loss report, and we're going to say the profit and loss. We've already seen it in the time period that has within the cutoff date. Let's have the first month after now, which is going to be 03/01/21 to 03/31/21. So the month after the cutoff date, March, and we're going to say run that report. And this is kind of the funny thing that happens here. So we've got this $25, which is a negative expense, and that really shouldn't happen. It's not like you can't really have a negative expense. That would be like income, really. It's not a negative expense. So the reason we're going to have this is that it will net out, like at the end of the time period, when the bookkeeper makes this journal entry and actually just records this, actually makes the payment, as they will. They're going to credit cash and they're going to debit the loan and then credit the expense by 152, this 152 here. And once that 152 nets out against this 25 that's already there, then it'll actually be correct. It'll be correct as of the point in time that the bookkeeper makes their normal kind of loan payment adjustment, and it'll reverse out at that point in time. So that's going to be the pros and cons that we have here. It's pretty much wrong right now, but it'll be correct as of the point in time that the bookkeeper does the next transaction. And so the bad side about that is it's not a perfect accrual until that happens. The good side about that is that the bookkeeping department, when we do these reversing entries, and this will become more clear when we do like a payroll reversing entry or the invoice reversing entry, the normal accounting process doesn't have to deal with anything different than their normal process because of our adjustments. So this process then means that everything's going to be correct on an accrual basis as of the cutoff date, and then because we make the adjustments then, and then we have some adjustments that are going to be not correct when we're not at the cutoff date because of the adjusting process and the reversing process. And that's just the logistics of the way we're going to have to work it. So that'll keep a good separation between the adjusting department and the normal accounting cycle processes, because they have two different goals in some cases. The adjusting department to make the financial statements perfectly correct on accrual. The normal accounting process to run a most efficient, logistically sufficient accounting cycle process. And this will keep those two kind of processes rolling along and still achieve those two goals. Hello, in this presentation we will enter reversing entries for accrued interest into QuickBooks Pro 2018. If you've been continuing along with us, we will be continuing with the Get Great Guitars problem. If not, that's okay. We're going to be talking about reversing entries and how to enter a reversing entry for accrued interest, a bit about what a reversing entry is, why they might be used within an accounting system as well. If you have the backup file up to this time, you can restore that by going to File and Restore. We're going to have the open windows open by going to the View tab and Open Window List. Within the open windows, we have the home page open. To open the home page, go to Company and Home Page. We're going to close the balance sheet right now and just take a look at the home page and start from here. We're going to be talking about the adjusting entry process and a reversing entry for the adjusting entry process. Adjusting entries are going to be done at the end of the time period. They're trying to put everything on an accrual basis as of the point in time that we're really looking at the financial statements and or distributing the financial statements. Last time we did an adjusting entry for accrued interest. Now we're going to do a reversing entry. Some of the adjusting entries will require or could use a reversing entry as one system that can be used in order to make things more efficient between the data input that normally happens throughout the process and the adjusting process at the end of the period. So in order to see this, we will go to Reports up top. We're going to go to Company and Financial and scroll down to the Balance Sheet Standard. We're going to change the dates to the date range we are working on by going to Customize Reports up top. Dates from 01/01/21 to 12, well, let's make it 02/28/21. So January 1st, 2021 to February 28th, 2021. Okay. We see our balance sheet here. Scrolling down, we're looking at this $25 interest. That was done with an adjusting journal entry. And we made that at the end of the time period saying that we owe interest on a loan that is outstanding right now of this $25. And we have a expense that we should be recording in this time period that we are covering related to that, even though we have not yet paid it. What we want to do now is reverse this journal entry so that when we pay the interest on the loan, we do not have to worry about this reversing process. In other words, when we pay the loan payments, typically we want the accounting department to just be able to write the check in accordance with whatever system we have, whether that be recording it in accordance with the accrual, the amortization table that came with the loan, or writing a check to the loan itself and having us just adjust it. What we don't want them to have to do is figure out how much of the accrual needs to be reversed at the point in time we write the check. One reason for that is that oftentimes the accounting department, the day-to-day journal entries is different from the adjusting process, which may be done by another department or by an outside CPA firm, and therefore we want to reverse that and not mess up the normal accounting process. That's what reversing entries do. They're not perfect, but they help us to make that separation and have the two departments do their thing without having the overlap messing each other up. So what we're going to do is we're going to reverse this, and reversing entries always happen on the first day of the next time period. So we got our financial statements correct. If anybody wants them, if we want to read them as of 2/28, the end of this month, then they are correct. That $25 is correct right there. We're going to reverse it as of the first day of March, and that will reverse it out so that we won't have to worry about that entry when we make the normal payment. So let's see what that looks like. First, let's take a look at this 25 and double click on that. Double click on this item. We entered this adjusting entry through the register, and we're going to do the same thing here through the register in terms of the reversing process. So this is one way we could get to the register. If I close this out and close this out, the other way we can get to the register is go to the banking drop down and then go to use register. We're going to select the drop down and we're looking for that interest payable again. So we're going to go to the current liabilities. We have the interest payable right here, and we will select that item, and we'll see there's the 25 right there. All we're going to do is reverse that. We're going to make the next day of the next month. So it's going to be 03/01/21. And instead of an increase, we are going to decrease by that 25. And then we're going to say that the other side of it is going to be interest expense. Interest expense. Now this is going to look funny when we record this, and we'll explain why and why we would want to do this. But we're going to reduce this amount back down to 0 and put the other side to interest expense. We're going to say record. And then let's go back to the balance sheet and see if it does what we hope it to do. What do we hope it to do? As of March, we expect this to go away. So we're in February 28th. If I change this date to one day next and refresh, then there's no longer that accrual there. It's gone now. If I want to see what happened, we can go back to the register, of course, and see that it went to 0, and that's why it's no longer there. So if we go back to the balance sheet, that's what we have there. If we go to the profit and loss, then reports, scrolling down to company and financial, scrolling to the first report, profit and loss standard, changing the date range from 01/01/21 to 12, let's make it to 02/28/21, January 1st, 2021 to February 20th, 2021. We then see that $25 right there in interest expense. That's what we want there because it needs to be included in an expense in order to really make our net income proper at the end of the day. If we make this the first day of the next month, however, if we say we want to now go to 03/01/21 to 03/31/21, the next month, then we have this negative interest there. And that should look kind of funny. We shouldn't have a negative interest expense. That's kind of weird. And the reason we have a negative interest expense is because of that reversing entry that we just entered. This is actually incorrect right now, and it will not be correct until we make the interest payment in this time period or make the adjusting entry at the end of the time period. So this isn't a perfect system is the point. These reversing entries is a system that works in that it makes things correct as of the cutoff date, as of the date we make the financial statements, as of the end of the month. And then it's not perfect in the prior time period because it results in this case to a negative expense, which looks really funny, shouldn't happen. But it will be correct once the normal interest payment is made. Then this negative piece and the positive piece that will be recorded when we make the normal interest payment will net out to the proper amount that should be recorded in this month. So at that point in time, we'll be okay again. And then at the end of the month, once we do our adjusting process, we'll be okay again. So the point here is that this makes us correct kind of on a periodic basis as of the end of the month once we do the adjusting entries, which we really have to do anyways to be really accurate. And it's not a perfect system in the interim periods, but as long as we recognize that, then it can be a system that works for us going forward, and it kind of separates the duties between the outside CPA firm doing adjusting process or a separate department doing the adjusting process, and the people that are actually entering the data, the day-to-day data, not having to deal with reversing those adjusting processes.